Hey traders, welcome back to Profit Without Panic. This is lesson 6.5, and I'm Karl Domm, and today we're tracking a crucial topic, why you're not diversified, even though you think you are. I'll get into why and what it has to do with modern market crashes and the phenomenon of crash correlation. If you've been paying attention to the markets, you know how unpredictable they can be, especially during times of crisis. Modern market crashes started with the May 2011 flash crash and have occurred on August 24th, 2015, February 5th, 2018, March of 2020, and August 5th of 2024. They occur about once every 2 to 3 years. You see, during events like the COVID crash in March of 2020, all asset classes tend to move in tandem, leading to significant declines across the board. For example, during that time, we saw gold down over 12%, TLT or bonds down over 11%, SPY down over almost 20%, Apple down almost 9%, BA Defense down over 62%, Target Retail down 5.5%, uh, LUV Travel down 33%. We saw Oxy in oil down 60%, and we saw Amgen and biotech down 6% in this time period. So what causes this alarming trend? It boils down to leverage and algorithms in the financial system. A small downturn can trigger a domino effect of deleveraging, leading to panic selling and wild spikes in volatility. This has significant implications for your portfolio. Many traders rely on modern portfolio theory, which assumes that at least one asset will be uncorrelated during the downturn. However, in a crash, all assets can fall together, leading to greater losses and rendering traditional diversification ineffective. And if you're an options seller, crash correlation can be devastating. A portfolio filled with correlated positions effectively behaves like one large directional bet, which can lead to high drawdowns and margin calls in volatile markets. So what can you do to protect yourself? The key is to hold positions that perform well during market crashes. It's crucial to recognize that many believe they're diversified, but they might just be betting on either long or short volatility. For example, you may be in different asset classes like long or short equity, risk parity, value investing, private equity, merger arbitrage, but in reality, you're 97% short volatility. The secret is being long an asset that increases in value during a crash. And there's only one way to be long a crash. And the answer is to be long volatility. Now, long volatility strategies aren't new. You can buy protective hedges like deep out of the money puts, but there's a catch. Every long volatility hedge comes with a cost that can eat into your returns during the stable periods. But don't worry, with the right options trade structure, you can achieve a more reliable way to diversify your portfolio, effectively managing risk in a crash while maximizing potential returns. By navigating market volatility properly, you'll be better equipped to make sound management decisions when the time comes. For instance, during the market crash on August 5th, 2024, my portfolio surged 7% in just one day. As soon as the market opened, my positions converted into cash, resulting in a 7% return, and I exited with a solid profit and was ready to redeploy my capital. As you gain experience and confidence, you can gradually expand your repertoire, but always prioritize mastery over complexity. So let's recap. Recognize crash correlation. Understanding that all asset classes can drop together during a crisis. Assess your portfolio. Modern portfolio theory is typically applied, most likely will not protect you as expected during crashes. Consider your strategies. Diversification is key, but it's important to incorporate strategies that perform well in the modern crashes during high volatility. In our next video lesson, I'll dive into pitfall number 6, over-relying on discretion, emotions, and subjectivity. I'll go over how to eliminate emotional trading and quickly conquer fear and greed for your long-term success. I'm Karl Domm, and let's continue on this path to consistent trading success together. Just click on the video popping up on your screen for the next lesson.